All right, so the market hit another high this week. It seems like we just keep going up and up and up. I want to talk about earnings. There's a few other topics I want to get into as well. First things first, if you get value out of this video, please like and subscribe. Really appreciate that. So first interesting thing I seen here from Jim Bianco. This is from 2 years ago. Forecast for U.S. recession within year hits 100% in blow to Biden. So obviously that didn't happen. And the whole point here is never get too bearish. Also, on the flip side, never get too bullish. Another interesting post I seen today, or yesterday it would have been, was CEOs or executives, I don't remember, but it was something along those lines, are buying their own stock at like a decade low level. So that definitely signals that the market is overvalued. But the problem that a lot of people run into is that they're too emotional, and they see things as too black and white. In that the market can be overvalued, but the solution is not to sell stocks and sit in cash. And on the flip side, the market can be undervalued, and the solution isn't necessarily to go all in. And obviously everything in between, right? My strategy is always look for value. There's always going to be value somewhere in the market. And personally, I am also buying, I changed up quite a bit about a week ago or so. I found that some of the stocks that I was dollar cost averaging in definitely are overvalued. I probably cut 5 or 6 of the 15 or so stocks that I was dollar cost averaging, and I might even cut 1 or 2 more. I got to look into it. So I'm honestly buying stocks the least I've ever bought, at least over the last couple of years, when I've kind of learned the ropes and became competent enough, I think, to be able to buy and sell individual stocks and whatnot. So that's just me. Obviously, I could be wrong. The market could still rip up from here. I don't think we're necessarily egregiously overvalued, even though we definitely are overvalued. There definitely is still pockets of the market that are undervalued, I think. But the one thing that you have to keep in mind is that just because everybody is doing something doesn't mean anything. I mean, in some ways it does, but you also have to keep in mind that once everybody becomes pessimistic, there's nobody left to sell, right? There's no selling left to happen, and that's where it's going to mark that uptrend. So when you see so much pessimism, and we're not necessarily seeing pessimism, we're seeing people saying, oh, the market's too expensive, which depends how you look at it. But in my opinion, there's a lot of people out there that are afraid to buy stocks. And when you also look at the fact that there's record amounts of money in money market funds, there's record amounts of money just sitting in treasuries, and those rates are going to come down. They're not going to come down as much as we think by the looks of things, given bond yields have came up over the last couple of weeks or so. That's not going to come down as much. But I mean, I think that the quote-unquote neutral rate is probably, I don't know, 2.5-3%. Like, that seems to be the number I'm hearing. And if rates on money market funds go from 4.5 to 3 or 2.5, a lot of the people that have their money sitting in there are going to have to put it into the stock market. So my opinion, the short and sweet on the stock market is I definitely think we're overvalued. I'm as cautious as I've been in basically ever, but for me that's only a few years or so since I've been in the game. The solution I don't think is to sell, and the reason for that is personally I'm still in my 20s, right? I'm still in my 20s, so my time horizon is longer than basically everyone. So I could care less if the market corrects 10 or 20%. That will not bother me at all. But if you're planning on retiring in the next few years or even 5 years, yeah, that probably is going to bother you. I'm not a professional money manager or an advisor. You got to do your own research on that. But the one thing that I think the data definitely backs up is that if your time horizon is more than 5 years or for sure 10 years, you shouldn't be selling stocks. If a 10 or a 20% drawdown makes you really nervous, then you didn't get into things in the first place for the right reasons. I'll just leave it at that. The other another interesting thing I've seen here as well. This is from Michael Burry, January 31st, 2023, and he simply tweeted "sell," and this was a tweet that went really viral at the time. I still remember it, the market hustle, play the long game instead. And this is the problem with falling into this doomer mindset, in that even though we definitely could see a drawdown, it wouldn't surprise me. The data is very clear. On any given year, there's like a 75 or an 80% chance that stocks go up. So why would you ever assume that things are going to go down? Because life in general, like just being able to understand odds and probability really well in your life is a massive advantage, like a gigantic advantage. And when it comes to stocks, if you simply assume that they're going to go up, you're going to be right 75, 80% of the time. And that alone is enough to produce crazy good gains. Now, like I mentioned earlier, it doesn't necessarily mean that you should use leverage or do something stupid like that, because that means you could lose really easy as well. But being optimistic rather than pessimistic when it comes to stocks pays off a lot more than it doesn't, right? So I'll just leave it at that. As far as the market goes this week, the S&P was up about 80 basis points. The NASDAQ not quite as much. And then when you look at the Meg 7, the Meg 7 was actually just up just a tad. If we look at the Meg 7 this week, NVIDIA actually hit a new all-time high, which I think helped drive the market up. But the Meg 7 was basically flat on the week. If you look at mid caps and small caps, was actually where it was at this week. I believe small caps actually had the best week, but I know mid caps were up over 1%, and small caps are up even more. So that's good news if you are, and this is what I brought up here as well, is that there are certain pockets of the market that can still do well. And I think that mid caps and small caps definitely play into that category. I think that it's really just, like, it's not just the large cap names that are overvalued, but on average, it is the large caps that are overvalued. That's where it's the large cap, growthier names that are overvalued. There's a lot of value still in the market on the value side of the market and on the mid cap and the small cap sides of the market. So, like I've mentioned time and time again, is what you need to be doing as an investor, whether or not the market as a whole is overvalued is frankly irrelevant. Now, if you're just a passive ETF or an index investor, then yeah, I think that that's fair. But if your time horizon's really long, I don't think it really matters. Also, if the majority of your holdings are individual stocks like me, my plan has always been to have probably 20 or 25% of my portfolio be indexes and the rest of it be individual stocks. And when it comes to the indexes, I buy a certain amount of mid cap, a certain amount of small cap, a certain amount of the S&P, a certain amount of the NASDAQ, and then a certain amount of a dividend growth fund every month. And I will play around with that depending on which areas I think are overvalued or undervalued. But I'm always buying. Like I'm still buying a very small amount of the NASDAQ every month. I'm still buying it even though I think it's overvalued. I'm still buying a little bit of the S&P even though I think it's overvalued. That's never going to change. The only thing that's going to change is the amount that I'm doing. So that's basically the markets for this week. I think that in the near term, the most likely trend is still up. It's still up until, we're going to need to get a specific catalyst for the next move to be down. I think post-election, something definitely could change. That's coming up in just over a couple weeks. And then going into next year, I think we possibly could see some weakness as well. But you never know. Like you really never know. In the near term, the most likely scenario is still up, right? Because in the near term, the most likely the path of least resistance is what has happened recently. So that's what I think is going to happen going forward. I still think we're overdue for a pullback, but I would be surprised if it happened like right around the corner. I think that it's going to be at least after the election before we see at least like a 10 or a 20% pullback. But we certainly are overdue for that. So don't be surprised if it happened tomorrow. But the near-term trend is still up. So be careful of that. If we get a week where the markets are down 4 or 5%, don't assume that they're going to keep going down, because the last 2 or 3 times that happened, they went right back up again. So nobody knows what's going to happen, obviously, but I think near term, I'm still bullish. I think over the next 6 months to a year, I think that's when we see that 10-20% pullback. That'll be enough to get people bearish, thinking we're going to see some big crash, and then we go back up. That's just my projection. We did have quite a bit of earnings this week, so I'm going to go through that. Bank of America, they beat earnings and revenue. This is a stock I don't think I ever would own. I think that JP Morgan is better, but it's a good barometer on how the economy is doing, at least to some degree. Same goes for Citigroup. They also released earnings this week. They also beat earnings and revenue. I think Bank of America is better than Citigroup, but that's just me. Goldman Sachs beat earnings and revenue. Another company that I don't think I would ever buy, just because I think that there's better options. Johnson & Johnson, another example of that. All of these stocks so far I watch mainly because they're popular stocks. They're larger names. I think the pharmaceutical industry is just too unpredictable, and I think that it's one of those industries that the government easily could regulate a lot of their profits away. So that's another one of the reasons why I'm not necessarily a fan there. They did beat earnings and revenue there. United Health, they actually missed earnings, a rare miss for them. They were down quite a bit on the week. They were actually up over 600 at one point. And this is one of those times where I think I timed, not the market, but I timed things perfectly, in that I did have a small position in United Health, and I sold it in the low 600s because I think that regulation is something that I'm really concerned about from the government on a company or on an industry that they are in. So I sold completely out of my position, and it was last week that I did that, and that was pretty much perfect timing. I still think they're a half decent company, but are they one of the best 50 or 100 companies in the market? I think not. Are they one of the best 500? Probably, but I don't think that it's realistic to own 200 stocks in a personal portfolio. I think 50 is probably, maybe you could argue 100, but I think probably around 50 or so is probably the sweet spot, in my opinion. And I don't think it's in that top echelon of companies, so that's why I sold out of it. Walgreens, this is a classic example of a dividend trap, and I believe they did cut their dividend recently. And given they have negative earnings, it's only a matter of time until they cut their dividend again, by the looks of things. This, again, classic example of a dividend trap here. Don't fall for this. They did release solid earnings, but don't fall for it. In my opinion, obviously I could be wrong, but I think that they're very overrated. I mean, they're closing down a bunch of stores, so this is definitely a stay away, in my opinion. United Airlines, they did beat earnings and revenue. Airlines, I've said time and time again, are an industry that I would never touch, but they are a decent barometer on how the economy is doing, so that's why I watch them. Abbott Laboratories, this is a company I've had on a watch list for like a year, and it's just never gotten cheap enough for me. And honestly, I'm not sure if it's quite good enough to buy. That's something that I would have to reevaluate it if it ever did get to a good price. I mean, a price of free cash flow of 36, a PE of 36 is just way too expensive. They would have to probably get into the low 20s before I would ever consider it. So definitely worth having on a watch list, but not worth buying, in my opinion. The next one, and actually I forgot to mention this at the start of the video, and mainly because I knew I was going to get into it, but ASML released pretty shaky earnings. They lowered their guidance, and they were down quite a bit on the week. Actually, they were down 22% at one point. They ended up closing down 17%. So if you bought them at the bottom, you actually turned out all right. But ASML, I changed my opinion on ASML. I used to really like them. I still think they're decent. I think they're kind of like a B- stock. They're good, but they're not good enough to buy, in my opinion. And something I noticed about them is like half of their revenue comes from China, and that's something that really concerns me. Honestly, I'm fairly bearish on China. I brought that up recently. Not because I think it's necessarily a terrible investment. I just think they're just gonna obviously underperform America and even to some degree Europe. And I'm not necessarily a fan of Europe either. And the main reason for that is they have terrible demographics, and their government doesn't do a good job managing the economy. So I'm definitely not buying ASML. And I mean, if you look at their valuation, they're still clearly way overvalued. Like, they're still way overvalued. I mean, they'd have to come down probably another 20% for me to even consider them. So this one's definitely a stay away here. Morgan Stanley, they beat earnings and revenue. Another company that, again, I probably never would own. PLD, this is one of the biggest, if not the biggest REITs out there. That's why I watch it. I think they're half decent as well. I probably never would buy them as well. I just think there's better options. They did release pretty solid earnings, though, so that's good news if you own them. Crown Castle, another one that I watch. I don't think I ever would buy, but I know they're popular out there. They missed earnings, but they beat revenue. They were actually up a little bit on the week. Discover Financial Services. This is one that I do watch. I might buy it if it ever got to a good enough price. They easily beat earnings and revenue. They were up on the week, not quite as much as I thought they would be, though. Steel Dynamics. This is another one I have on a watch list. I definitely would buy if it got cheap enough. They released good earnings. They were up quite a bit on the week, so congrats if you own them. They are still too expensive where they're at right now. They're not like they have like a 12 PE, which is not expensive, but that's way above its current averages. Price to free cash flow of 48. They're too expensive where they're at right now. If they got back to their historical averages, I definitely would buy, but I don't think they're there yet. BMI, Badger Meter, another company I probably would buy if they got cheap enough. They beat earnings. They did miss revenue by a little bit. Very good company in my opinion. They're just too expensive, and they were down on the week, but still way too expensive. Blackstone beat earnings and revenue. They were up a lot on the week. Another company that I think is decent. I'm not sure if I ever would buy, but I do have it on a watch list nonetheless. Another company here that's too expensive, but I definitely would buy if they got cheap enough, is Intuitive Surgical. Very good company in my opinion. They beat earnings and revenue. They were up quite a bit on the week. Very good company, just too expensive where they're at right now. Netflix also released earnings this week. They released pretty good earnings. They beat earnings and revenue. They were up a lot on the week. So that was earnings for this past week. I'm not sure if it's next week or the week after. We're going to have several of the Mag 7 will release. I believe it's Google, Amazon, and I'm not sure if it's Apple, but I know there's in the coming weeks we're going to have all of the Mag 7 stocks except for NVIDIA. NVIDIA is usually like the last week, probably I think it's like 3 weeks from now. I think NVIDIA will be releasing, so stay tuned for that. That definitely will drive the markets as well. If the Googles and the Amazons and the Apples of the world, if they release really good earnings, then that's going to drive the market up even further. And I probably would lean that way if I was guessing. So keep an eye for that. We could see S&P 6,000 in the coming couple 2 or 3 weeks. That is definitely on the table. So stay tuned for that. Like I mentioned at the start of the video, if you got value, please like, subscribe, comment. Really appreciate that. And stay tuned for more.